Good morning from London. This is Bloomberg Markets Today. I'm Kriti Gupta alongside Lizzy this morning. With a cash trade just less than an hour away, here's what you need to know. Bloomberg reveals that the U.S. is slowing AI chip exports to the Middle East amid national security concerns. The news weighing on mega-cap tech shares overnight. A historic moment as Donald Trump becomes the first former U.S. president to be convicted in a criminal case. We'll talk about the implications throughout the show. Plus, division at the Federal Reserve. John Williams says policy is restrictive, while Lori Logan says it's not enough. We're going to dive into the thinking out of the PCE deflator later today.
Good morning. Happy Friday. Let's check in on these markets. Stocks down, bonds up yesterday off that US eco data. Then Nvidia taking a blow from those US chip restrictions. Now we await the European read-through. And of course, PCE, the data highlight of the week. Futures flat here in Europe. The 10-year Treasury yield stable. Euro dollar 108. Markets today starts right now.
All right, good morning. Thank you for joining us this Friday because there is plenty to digest. I was ready for a sleepy day, and we got the exact opposite of it, from the U.S. stock story to the politics to, of course, what we're going to get later today. There's a lot to digest. But, Lizzy, let's kick it off with what we saw in the U.S. session yesterday. This is the first time, and I think this has been the theme all week, actually, where you're starting to see some of the geopolitics kind of start to frame itself in the market narrative. Bloomberg saying that the U.S., or reporting, I should say, that the U.S. is slowing those AI chip exports to the Middle East, specifically targeting Nvidia, AMD. You saw a massive sell-off in the U.S. session.
Yeah, I think what's really interesting here, it's not necessarily that the U.S. is afraid of the threat from the Middle East, right, even though you have got major players like the UAE and Saudi Arabia trying to build themselves as AI kingmakers in the region. Actually, potentially, it's about the read-through from China through the Middle East into the U.S. And now this morning, of course, we look to the likes of ASML to see how they get affected.
Yeah, the European read-through is going to be crucial. And remember, we've had this theme throughout the week where the Salesforce numbers, for example, overnight in the States had a big read-through in the likes of SAP, among others. So that's going to be one we're going to keep an eye on. But it's not the only tech story we're watching. You had Dell earnings come out. You even have TikTok, for example, reported at least coming out of Reuters saying they're going to be tweaking their algorithm. The tech story is getting more and more global. It's that U.S. economic resilience, or that U.S. even stock resilience, that doesn't seem to be sticking anymore.
Yeah, it was interesting to see, actually, TikTok responding to that Reuters report, saying it's misleading and factually inaccurate, that basically they're cloning the algorithm, working around it so that they can be a version that operates independently of ByteDance, but still massive if it's true. And yeah, we've got Apple planning an overhaul to Siri. I mean, I'm always wondering, Kriti, why I can't hang up the phone with my voice. Now we're going to be able to control all the apps with our voice, it looks like.
And it's crucial for Apple as well, because Apple's been so late to that AI trade, where you've seen it with NVIDIA, you've seen it with Microsoft and that 49% stake in OpenAI, for example. But Apple has really been trying to revamp their strategy around it, for example. They were late to the car business as well, shutting down those kind of projects that had been in the works for a decade, revamping their AI space. But this is the big piece of it, right? This is one of the hyperscalers for the likes of NVIDIA.
Yeah, and of course, the point is that now you're going to have to update your Apple device. But there are lots of privacy concerns about this development, because if it's going to be handled on the device or the cloud, you know, it raises all sorts of privacy questions. So let's see if this develops as smoothly as Apple would like.
We should. And so already we've hit, I think, like 4 or 5 companies in just that. We should come back to the Dell earnings, though. This is important in the context of Salesforce, because we know that some of the old guard tech, your Salesforces, Salesforce as an old guard tech is a little bit of a stretch. But you know what I mean? Oracle, HP, your enterprise software, anything that isn't AI seems to be the laggard right now. Dell, on the other hand, coming out with that as well. I thought the earnings story is starting to crack in the tech space.
Yeah, look, the results weren't bad, but the expectations were high, and that's the theme of all the AI earnings right recently.
It is. And so that's the tech story. Let's talk about the political story. This, I think, is catching headlines globally. A historic moment in U.S. politics. We're getting the former president, Donald Trump, convicted in a criminal trial for the very first time.
Yeah, of course, you were up all night following this. Let's check in on what he had to say. Donald Trump found guilty in the first criminal trial of a former U.S. president in the nation's history. A New York jury convicting him on all 34 counts in his hush money case. Trump, who faces as many as 4 years in prison, insists the trial was rigged.
This was a disgrace. This was a rigged trial by a conflicted judge who was corrupt. It's a rigged trial, a disgrace. They wouldn't give us a venue change. We were at 5% or 6% in this district, in this area. This was a rigged, disgraceful trial. But the real verdict is going to be November 5th by the people.
All right, let's bring in Bloomberg's Brussels Bureau Chief Kevin Whitelaw. Kevin, I know that Kriti and you are deep in the detail of this. I'm going to give a voice to the Europeans waking up this morning thinking, what the about this story? Look, if he can't pardon himself, if he loses the appeal, is he going to prison, win or lose? And how could that not be during his term?
Well, it certainly could be during his term. We're in extremely uncharted territory in U.S. politics. This is not a federal case, so it does mean that Trump really can't pardon himself for this one. But the appeals process in the U.S. can take a long time, and Trump is known to exhaust just about every possible legal avenue. Remember, he's facing. This is one of 4 trials, and all the other 3 are so far being delayed and look like they're all going to start sometime after the election. And so he's very good at dragging these things out. The sentencing is July 11th. That means that's 4 days before the Republican convention. After the sentencing is when he could start his appeal process, and that can obviously take some time. So do we have the possibility that he wins election in November and then faces jail time down the line? Absolutely. But keep in mind, these charges are all felonies, but they're sort of the lowest level of felony in the New York system. And so it's not inevitable that the sentence is going to include jail time.
And Kevin, this is fascinating. Lizzy was talking about it. I was quite literally up all night just reading every piece of information that was coming out. And for Global Audience, we should mention Kevin is in Brussels now, but has a long history of covering American politics. But Kevin, build on that for us, because even in the face of a historic moment, a criminal conviction, even on the state level, you were still seeing pretty widespread support for Donald Trump.
Yeah, I mean, look. For the people who love him, he's been able to build this up successfully as, sort of this big, liberal conspiracy against him, rigged jury and all of that. Look, this is still 12 jurors. Every single one had to agree unanimously to every single count, so that, all it took was one person to have blocked any one of those 34 counts. And so you still had 12 people actually, choosing to say that he was guilty. That's still a big deal. It is going to have an effect on some voters, but there are so many people that have just made up their minds. I think, it's also not just about whether people are going to change their minds. It's also about the energy on Election Day and who's going to turn up. Does this kind of thing, the fact that he's actually been found guilty this time, does that really dent maybe just some of the enthusiasm for whether people actually show up to cast their vote? Are some people just kind of tired of this circus that surrounds him? Or does this simply sort of harden the battle lines and just sort of have everyone retreating to their corners? We'll see how it plays out, obviously. But since we're in such uncharted territory, it's really hard for anyone to predict this.
I mean, they're the voters. What about the backers? We're reporting Bill Ackman likely to endorse Trump. Do you expect more billionaires to come out of the woodwork now that we've got the verdict?
Well, look, the numbers so far have shown that support for Trump is very strong, and Biden is really still suffering and really struggling to figure out how to sell what he's done in his term. And he's sort of historically unpopular for an incumbent. Really even below where Trump was at the end of his first term. And so for people who want to be part of the next administration, have a line into the next administration, Donald Trump is still sort of where the energy has been to some degree. And so I do think there will still be people that come forward and back him. We've seen that for the folks who want to do that, they're pretty impervious to a lot of these other effects. Having said that, again, still in uncharted territory. It's a felony conviction, 34 felony convictions, no matter whether he ends up serving jail time. That's happened.
All right, Bloomberg Kevin Whitelaw, great to have you with us on the programme. We thank you for that. And Kriti, I'm glad you're here, obviously, to talk about this as well. It's not just Ackman, it's Musk as well, trying to get in on the influence with Trump.
Yeah, and Elon Musk in the same time talking about being a consultant on the crypto sphere with President Trump in his campaign, also talking about hosting a potential town hall as well. They seem to really be cozying up. I think what's crucial here, and Kevin made that point, that if you're backing Trump, if you were a Trump supporter, nothing can really seem to get in your way. It really speaks to, I think, for an international audience, just how polarized American politics are right now and why this Trump versus Biden show-off was really established so early on in the campaign cycle. Even in recent days, Nikki Haley, for example, who was really vocal about not supporting President Trump, actually issuing her own endorsement. And it speaks to this idea that even the divisions within the right, within the Republican Party, within the GOP, ahead of trying to brand themselves as kind of solution to the American finances. Remember, the debt ceiling looms over all of this. They are still uniting in the face of what's going to still be a very polarizing election.
Yeah, and very much the sense that people are backing Trump now because they feel like they don't have any other option. I mean, I'm wondering, as an outsider, how big that swing vote is, because I expected the hardcore voters to be even more in favour of Trump after a verdict like this. But how big is that swing potential? Yeah, well, I'll go to the polls in a minute, but I think a great kind of way to go into this is when and I'll just speak kind of just from a first-hand knowledge. When I covered this outside of the courthouse, we had David Gura doing this. This has been in the works for about 2 or 3 years here. We used to go down to the Manhattan courthouse, and there were protesters, of course, against President Trump, but plenty of protesters for President Trump as well outside of the courthouse, despite some of these very grave allegations. So when we talk about what that swing vote looks like, there have been polls that have suggested that if you were an independent voter, which, by the way, that voter base has grown in the face of some of Biden's foreign policy decisions, specifically around the 2 wars in this region, you have said that if there was a unanimous jury, that perhaps they would start to see a move away from President Trump. That being said, take a look again at his voter base. It has only gone stronger even as we get these developments. And again, this is just a criminal conviction on the lowest level, as Kevin said, in New York State. He's still dealing with charges of treason or potential charges of treason in other parts of the country, which, again, as Kevin said, have completely been on ice. OK, well, we're not short of drama this morning, and we'll continue to talk about that. But there's plenty on the docket elsewhere this morning in terms of the economic data, because at 10 a.m. UK time, we're going to get the Eurozone inflation data. Really a bit of a muddying of the waters in the past couple of days in terms of the path ahead for the ECB beyond June. We'll discuss that. At 1:30 p.m. UK time, we get, of course, the highlight of the week data-wise, US PCE. Then at 1:30 p.m. UK time, it's Canadian GDP. And over the weekend, on Sunday, OPEC Plus is meeting. We can look at how the supply dynamics have been contradicting, conflicting with the geopolitics and US stockpile data as well. Also, we're keeping an eye on the elections happening in emerging markets. We get South Africa's results, the Mexico election and the India vote counting too. Lots of implications potentially for currencies in the EM space. It's really interesting as well. And as we look ahead, you mentioned the PCE data. This is so crucial when we saw some poor numbers coming out on income and spending as well. We do get some numbers out today, as you just walked through. I think what's crucial is coming off the back of Costco earnings, Best Buy earnings as well, which actually suggested they were pretty decent. Costco, for example, I'm going to nerd out a little bit, and I think you actually have Costco here. I've never used it, but it exists somewhere. I haven't found it yet, but it's somewhere in this. But it's important because Costco, and this is a very, Guy Johnson isn't here. He loves to talk about gold bars, for example. Costco sells gold bars, and people are buying gold bars from Costco, which I'm trying to think of that for a European audience. It's the equivalent of going to, any supermarket, really, and buying gold bars. It's a very wonky thing. And I think what's so crucial about it, and the reason I bring it up here, is because suddenly you are seeing these cracks in the tech space. You're seeing these cracks in the consumer data. It hasn't yet trickled across to some of the retailers yet, like Costco, for example. You have reports this week as well that the likes of Walmart, Target, for example, are actually cutting prices. That never happens. You never see in a inflationary dynamic actual
big box retailers cut prices to keep that consumer demand resilient. But it looks like that's the narrative that's starting to emerge.
Interesting to see Foot Locker up 31% on its results. Birkenstock at a record high. Who knew? And actually that helped JD Sports yesterday. So there is a read-through over to Europe.
Yeah, and it's certainly something we're going to be keeping an eye on as well. From the bond market perspective, this PCE deflator is really crucial because, look, we've got a few tepid auctions. We've got that T+1 settlement in the stock market, which, by the way, has passed with flying colors, it seems. There's another one today in terms of the MSCI funds rebalancing around the world. There's still a little bit of volatility ahead. We can't quite log off on this Friday ahead of the weekend.
Turns out plumber Kriti wasn't needed after all. But coming up on the programme, we're going to look ahead to this weekend's OPEC Plus meeting, where the group's going to aim to finalise a deal on oil output cuts. But up next, back to the markets as traders await the inflation data, that core PCE number. If you've got any questions or of your own or for our guests, please do send them in on IB to +BBTV Go. We've got plenty more coming up. This is Bloomberg.
Fed policy is basically working, I think, as designed. I think the lags are longer, but their policy, I think, is basically working. It's putting some brakes. There are signs of slowdown. It's not dramatic, but you can see the economy getting a little bit softer. And I think if you're the Fed, you really have to slay the inflation dragon. You know, the worst thing they can do is take their foot off that brake too fast.
Goldman Sachs President John Waldron there speaking to Bloomberg, saying the worst thing you can do at the end of the day is take your foot off the brakes a little too fast. Let's get a little bit more perspective on here. Ben Gutteridge, portfolio manager for multi-asset strategies over at Invesco, joins us this morning. We thank you so much for coming in on a Friday, nonetheless. Taking the foot off the brake too fast, the possibility of rate cuts, but also rate hikes seem to have been recently introduced into the narrative. How seriously are you taking the risk of a rate hike out of the States?
Well, I mean, not complacent to it. I think that is something that markets would revolt at because, you know, I don't think you do a one and sort of done. I mean, you're sort of signalling that we've got to do something quite forceful here to tame this inflation menace. So a rate hike, I think, would be pretty bad news for markets. So not complacent to that, but not part of our core view at this moment. Clinging on to the to the disinflationary narrative, aware that it's there's some vulnerability to it, but I think there is enough in there to maintain disinflation as the core view, and that the next move would be a rate cut.
So then let's talk about the view on the bond market here. For so long we were talking about what the ceiling in yields are, but it feels like with this kind of higher for longer narrative, this possibility of these cuts getting pushed out, the question is really, where is the floor in yields? What's your take?
Well, it's great that we're sort of considering where the floor would be. Most often we're sort of thinking about the ceiling. So I appreciate the change of tack, the pivot there. But I mean, I think we need to see, before we start thinking about what the floor is in too much depth, I think we need to see the labour market conditions deteriorate more meaningfully. I think at the moment we're comfortable that we're at or around highs on that that 10-year yield, and that the move would be sort of lower. But we could be in this trading range. But I think the next significant move would be lower, and that would be a function of labour market weakness, sort of spooking fears of recession. Not an imminent risk, I don't believe. Perhaps an underappreciated one, but as we get into next year, I think labour market weakness could mean the next significant move in yield is lower, and then maybe I'll come back with a number on the floor for yields.
Ben, just as a fellow Brit on this panel, I just want to see if you share my perspective on the news about Donald Trump that we were just discussing, and really what the market is reacting to this, because it seems really shocking here in Europe.
Well, look, I mean, I do watch the news. I watch this show religiously, so I'm aware of the challenges that Trump comes up against. But like yourself, I guess, implicit in the question, it is still quite shocking. I don't know if in America they're sort of a bit more diluted to it, but for here it just seems like movie type stuff. But you know, I have seen markets deal with these. You know, it's hard to call it sort of similar, but you know, these types of shocking political events can move through them, because I guess sort of the base case although I wouldn't pretend to have a total grasp of the US legislation, is that Trump doesn't sort of go to prison and doesn't sufficiently disrupt the campaign to that degree. And, of course, if he gets into office, then this problem can go away. And if he doesn't get into office, then, you know, it's just a sort of a sideshow. So I think markets can deal with it. But like you, yeah, it's still pretty shocking news.
And Kriti was talking as well about the US consumer and all of this. I know that you're very excited about tech, but I do wonder about how confident you are in the strength of the US consumer, who, of course, is also the voter. And the US consumer voter is very different, a different breed.
Yeah, well, I think we are quite positive about US consumption, the tailwinds that can be more enduring, but there could be some creep on that. You know, I think the labour market is starting to fray. So we're talking about resilient growth and consumption being supportive. But at the margin, you know, with hiring rates falling, with quits rates falling, these types of things suggest wage inflation might continue to moderate, which chips away at consumer confidence. And, of course, that could feed into, you know, a popular dissatisfaction with Biden and be supportive for Trump. But the position is we're supportive on the US consumer, but alert to the weakening dynamics that are starting to build, but not yet to derail our sort of preference for equities.
It feels like the equity story is turning into not only a momentum story, but a liquidity story at the end of the day. That if you were looking for a safe asset globally right now, given the volatility in monetary policy, given the election risk, I'm going to throw in the debt ceiling in there as well, showing up next year. It feels like the U.S. equity market is more of a safe haven bid than anything else. Your thoughts?
Well, I would largely agree. Calling it it feels like our safe haven bid because that's where the core view is sort of pointing. Coming back to sort of the rate hike type environment, heaven forbid, you know, you get something of that kind, you know, repeat of 2022, you know, with commodity price shocks, inflation behind the curve on inflation and central banks moving faster on interest rate hikes. You know, that doesn't look like a very welcoming environment for US equities. But in the environment where, you know, earnings continue to meet some pretty lofty expectations and in certain circumstances exceed those, and you have a Federal Reserve whose next move is to cut rather than hike. Obviously, the pace at which those cuts come and when they start is to be debated. But resilient growth, disinflation, earnings momentum, you know, US equities stack up very well in that environment.
All right, I'm putting you on the spot here. 30 seconds. Get ready. Fire round. How long does the party last when it comes to U.S. equities, though? You've already seen this massive rally. When does it stop?
Well, I think we have at least sort of 6 to 12 months before we can... What's a good analogy for a party ending?
The music stopping?
Before the music stopping, of course. Before the music stops. Sorry.
It's Friday.
We should be turning the music up, I guess, on a Friday. No, I think we've got 6 to 12 months before the labour market weakness starts to come through of such scale that recessionary risks permeate rather than the disinflation story.
All right. He did good in 45 seconds. And that's why we're going to keep him, because not only is he bullish on U.S. equities, he's bullish on UK equities. And we're going to dive into that call next. Ben Gutteridge, portfolio manager at Invesco. You're not going anywhere. Stick with us. That conversation is coming next. In the meantime, a quick check on these markets. You are seeing futures marginally higher. Nothing too exciting at the moment. We are, of course, waiting for that read-through from what we saw in the States. Remember, a sell-off overnight. You're seeing a little bit of weakness over in Asia as well. Some of that coming up from the Chinese bond market. We're going to dive into those dynamics. All that coming up and more. This is Bloomberg.
I think it still can, of course, but the risk is much higher. The problem of Royal Mail is one historical and one more recent. The historical one has been the governance struggle that is frankly in Royal Mail since privatization. And the company, because of this governance struggle, was not really able to show sufficient flexibility and adapt to the changing underlying reality. Royal Mail has effectively converted from mainly mail business into mainly parcel business. And the inherent feature of the parcel business is that this is a very competitive business. And Royal Mail is facing a very severe competition from Amazon, from DPD, from every newly also in a smaller scale from Impost and DHL. So really it needs to fight on the market. It needs to be competitive. This is not a fight about, what are the terms for the employees. This is first of all a fight where the Royal Mail is capable of delivering the right services for the right price and hence be competitive and hence preserve market share. If these conditions are not there, clearly the company goes into a deadly spiral world because of the universal service obligation. It needs to keep the UK nationwide coverage. It has a fixed cost base, but it's missing revenues. So one of the problems which I've made a reference to, was this governance struggle, which has been somehow overcome really last year. We have a new ground for the relationship with the union, and hopefully we have both understanding. All stakeholders understanding that the company needs to be more flexible and needs to accept the new reality where parcels are representing majority of the business. So this is the continuing traditional historical problem that has really negatively affected Royal Mail. What we can say also that this kind of difficult situation has been even enhanced by the fact that the rules for universal service obligation in the UK are, if I'm not mistaken, just with the exception of Malta, the most strict and the most rigid in the whole of Europe.
So that was, of course, the Czech billionaire EP Holdings chairman Daniel Kretinsky speaking exclusively to Bloomberg. He planning to fund the takeover of International Distribution Services, which is, of course, the owner of the UK's Royal Mail. And that would be with both equity and debt. But speaking of people who are keen on the UK, we've kept him with us. It's Ben Guttridge, Portfolio Manager for Multi-Asset Strategies at Invesco. I'm glad you're here, Ben. You have been a rare voice of positivity in a room of naysayers on the UK, and this is exciting because, of course, Rishi Sunak has called a snap election. I wonder, between now and July the 4th, in the politics, is there anything that could dent your enthusiasm for UK equities?
I don't. I think there'll be a creeping of promises that will be met with resistance from inquisitive journalists like yourself about, how can this be achieved, and Institute of Fiscal Studies, again, might sort of push back on how much is sort of being promised. But I think it's unlikely that the campaign trail, he says, is going to do enough to derail what looks the most likely outcome. I think the uncertainty resides in the majority. Like I say, it's got to be forecasting careers can die on these sort of things, but I think the uncertainty lies in the majority that the next government accrues. But I think in the first instance, the new government would be cognizant of the mistakes sort of made in prior governments, pushing too hard against public finances, being too bold, and certainly with inflationary pressures not yet tamed. So I just don't think the campaign is going to deliver enough surprises to derail the result, and I don't think we're going to get a government that's going to act imprudently, certainly not in the first instance. I don't want to downplay how, the radical ambitions of a new government that I think they harbour, but I don't think they're an immediate priority.
Yeah, but perhaps that is the question that people need to ask, because at the expense of being so worried about, igniting the bond vigilantes, are they perhaps going to risk not being ambitious enough in terms of their plans for growth? That's a question to ask. There's also the one you raise about the possibility of a hung parliament. I mean, if it is a hung parliament and there's no majority, where does that leave you in the market?
Well, look, I think the market can deal with things like hung parliaments. It means that parties have to work together, and you get less radical sort of policy changes and almost sort of policy near policy continuity, because you can't do too much. And markets don't mind that type of outcome. So hung parliaments, like, a fascinating politics, and of course can have impacts on us in sort of individually and what policies are sort of chosen. But I think collectively, at an aggregate level, as far as the market's concerned, probably deal with things like that. But yeah, I mean, look, there's no doubt that a Labour government would have ambitions to see more state intervention, that sort of type Bidenomics and that type of policy agenda. But I don't think it would deliver on that until the inflationary environment is much more benign and the public finances give a little bit more wiggle room. So there could be a little sort of disappointment on growth for the UK, you know, in the preceding sort of 6, 12, 18 months following a change in government. So markets might be alert to that risk. But I don't think there are expectations of outstanding growth for the UK. I think they still remain pretty downbeat. And anything that a new government can deliver, I think, would be an upside surprise.
All right. Again, I'm going to put you on the spot. This is kind of the trend this morning. When it comes to the UK equity picture, though, you're fairly bullish, as Lizzy pointed out. But is that a result of a catch-up trade to U.S. equities, the read-through, or is that simply just given that the FTSE, for example, is still gets so much of its revenue from internationally as opposed to right here in the UK, or is that actually a regional story?
Well, I think there is certainly a valuation catch-up story that can be discussed, but I know that's been rolled out time and again, and it's just failed to deliver. I think what we are seeing now is some catalyst that might deliver on that value, such as management action, you know, delivering on maintaining dividends, but delivering on buybacks as well, and I think that's like a good news story. Sorry, am I out of time?
No, those are my favorite two words, buybacks and dividends. You wait till the end to say it. Come on, Ben. Ben Gutters, their portfolio manager at Invesco. We have to let him go, but we are thrilled to have him. And, of course, one of his core arguments around being bullish in the UK is also he's bullish around the U.S. as well. And that's a really interesting dynamic. Given in the context of the last 24 hours, the U.S. stock market has actually sold off on reports that the U.S. government may actually slow down, already is slowing down some of those licenses for chip making with NVIDIA, AMD, and it feels like the Middle East has suddenly come into the global narrative when it comes to pricing in some of these geopolitics. And that's where we go next from a different angle. OPEC Plus delegates have told us the group is moving closer to an agreement on oil output cuts that may stretch into 2025. I want to get more on the story ahead of Sunday's meeting. Bloomberg Horizons anchor Jumana Berceci joins us this morning from Dubai. Jumana, a pleasure to have you on the program. OPEC Plus, of course, expected to roll over those production curbs into the second half of this year. Why now? What could change?
Yeah, good morning to you, ladies. Well, look, let me just take it back to that decision that OPEC Plus took towards the end of last year, November 30th, when they decided to take another 2.2 million barrels off the market. And the reason they did it is because they wanted to support the price of oil. They did not have strong visibility on how the dynamics were going to play out in the next 6 months. And I think it is pretty remarkable that you fast forward to today, and we are once again in a situation where OPEC Plus are thinking of extending those production curbs out to the end of the year. And if our Bloomberg reporting is correct, possibly into 2025 as well. So the matters that they're taking into consideration, obviously within OPEC, they're sitting on a lot of spare capacity. The likes of UAE, the Kingdom of Saudi Arabia, nowhere near pumping at full capacity. So that in itself is a bit of a buffer to the market. But then even outside of OPEC, you look at non-OPEC supply, the likes of U.S. production continues to grow. U.S. inventories, the highest level they've been all year. Guyana bringing new oil to the market. The likes of Canada also producing more and more. So they've got to factor in non-OPEC supply growth into their outlook. Paired with that, the demand outlook. Not so long ago, the IEA actually revised down their forecast for demand growth for the rest of this year. It's about 100K lower than where it was 1 year ago, and tells you some of the warning signals are coming through, especially from the likes of China. Final point, ladies, that you need to bear in mind is compliance within OPEC. So it's all very fine and well for them to come out with 2.2 million barrels per day production cut target. But anyway, you look at it, they're still overproducing by 500 to 800,000 barrels a day. So compliance within OPEC is also a sticking point.
I mean, Jumana, we did just have that China factory data this morning shrinking, a surprise hit to the growth outlook. Just talk us through how that factors into the oil outlook, because this is the group's largest customer.
That is exactly it, Lizzie. And I thought those PMI numbers this morning were super interesting to look at as well. I mean, you look at the macro data coming out. China started out the year strong, and I think there were lots of expectations about that post-COVID recovery and what that would mean for oil demand. And yet the signals the last few months have not been so positive. PPI has been negative for 19 months. You combine that with the downturn that we're seeing in the construction market. Why is that important? Well, because it's a key indicator for diesel demand. Less diesel demand means there's less refining rates. Refining rates have started to fall. Actually, the slowest rates since December. Some of the refiners are even operating at half of full capacity. So you take that all in conjunction, and it tells you that the OPEC plus producers are looking out into the second half of this year and probably feeling a little bit nervous about some of the more recent signals coming through from China.
All right, Bloomberg's Jumana Basecci in Dubai, our Horizons anchor, of course. Do check out her show, 5 a.m. London time every morning. And of course, the OPEC Plus meeting coincides with that Aramco share sale. Saudi leading the efforts to restrict output. Saudi reliant on these output cuts to balance the books. So an important story to watch over the weekend. An eye on the oil price, Brent at $81 a barrel currently. Coming up on the programme, stocks to watch, including Telecom Italia, after the EU granted approval for KKR's €22 billion bid for its landline network. We'll bring you the stocks to watch ahead of the open next. This is Bloomberg.
Welcome back to Markets Today. We're about 15 minutes and change from the cash equities open. We are seeing futures marginally higher, but again, nothing to write home about. Right now, we are seeing headlines across the Bloomberg terminal. French CPI coming in about 2.7% year over year. The estimate was 2.6%, so coming in a little bit hotter, but you aren't necessarily seeing a reaction when it comes to the euro. 108.20 is where we're at there. Remember, this comes off the back of soft German inflation data this week, but also strong Spanish inflation data this week. Let's get a little bit more insight here. Joining us now this morning, Markets Live executive editor Mark Cudmore with his Markets Minutes this morning. Mark, I mean, as the American in the room, I already am learning that these countries, 27 different ones, are all on various paths. So it's hard to get them all on the same page. But it feels extraordinarily different in that the euro isn't reacting to a lot of these contradictory reports. How do you make sense of it?
I think that euro-dollar this year has been really dominated by the dollar side of the component side of the equation. Obviously, the big narrative has been the changing story around Fed rate cuts. And in many ways, that's been kind of dragging interest rates around the world. I mean, one of the interesting things this year is that we've actually seen a large divergence in the economic stories, and yet we haven't seen such a great divergence in the rate stories. That, you know, U.S.'s growth has been really holding up extraordinarily well and would imply that the yields should not be cutting at all, whereas growth in Europe until very recently has been really, really poor. And yet when US rates priced out many of the rate cuts earlier this year, ECB also priced out some rate cuts. So I think that I'm not overly surprised we're not reacting too much to the European inflation story. Euro-dollar is very much the dollar is in the driving seat.
Well, let's talk then about the ECB in particular. We are less than a week away from a decision that's largely expected to be a cut. Is there going to be a market reaction in the next 7 days, or is that already priced in?
The cut won't get any reaction, no. I think obviously everyone's keen to hear the latest wording on what comes next, but I think the market's going to be disappointed if they're expecting clarity about how many more rate cuts to come after that. Look, this is a ECB where Christine Lagarde is dovish and she's leading a dovish faction, but it's clearly a divided central bank in terms of what the next steps are. I think the fact is, we just talked about European growth is slower than much of the rest of the world. It doesn't have as bad of an inflation problem, but globally, inflation is sticky because of the services component, and now also because of the more volatile goods component, we are seeing reinflation because we're seeing higher commodity prices, higher shipping prices. So I think that ultimately too many rate cuts are priced in for the ECB still. Is next week going to bring us clarity in that? Probably not. So people are just going to trade off their a priori biases ahead of the meeting.
Yeah, difficult balancing act for Christine Lagarde in the comms after that ECB decision, of course. Not only has she got a divided counsel like you have in the Fed on the path ahead, but also this conflicting data. Look, Mark, thank you for that. We're going to keep you there. I just want to nerd out a little bit on another central bank, my favourite, the Bank of England, because we have had some pretty nerdy action happening over the past couple of weeks. We've been tracking the Bank of England's, banks' demand for the Bank of England's cash in the weekly auction. And yesterday we saw the 6th straight record week of demand for repos, repurchase agreements. So basically what's happening here is the BOE's bond sales have cut the amount of spare cash in the economy. It's the lowest since 2021. And then we've got analysts like Peter Shafrick at RBC worried that if liquidity drops too much, it's going to drive up borrowing costs in money markets and hamper the Bank of England's ability to cut rates. So they want an end to QT potentially, but then we have the Bank of England Governor Andrew Bailey calling the bid for cash encouraging because he wants the BOE to satisfy the system's liquidity needs through the repos rather than bond buying because it doesn't add interest rate risk for the bank, and that risk now causing losses on its holdings. So, Mark, let me come back to you here. Settle this debate for us. Who's right? Should Andrew Bailey be more worried about this repo action?
Lizzy, I'm loving this nerding out. I have to admit, you're bringing this to my attention. I've not been following the UK repo debate, and so therefore I don't have a massive amount of specific UK-based wisdom to add. But what I will say is that, you know, if you look at the kind of the Fed story where I've followed the repo debate for much longer and much more carefully, I think it's one of those issues where it is super important to treasuries traders, to people who are in these markets, to money markets traders. It's not the macro story that sometimes we get, confused by the headlines. It's kind of similar to the T+1 story this week. Yeah, much of the market was talking about it, but frontline market professionals didn't care. They paid attention for one day to see if it would cause disruption. No, it didn't. It wasn't a story. Sure, it matters for settlement people. It matters for the industry. It matters for many people, but not for frontline market professionals who are deciding whether to buy or sell. And I suspect at the moment that's still the case for the UK repo story. At some point, these things intensify enough to become a spillover risk aversion because of the liquidity tightening. But I don't think we're close to that yet, if we're only just starting to get really nerdy about it.
Bloomberg Markets Live executive editor Mark Cudmore, we thank you so much for bringing us that insight. Remember, you get more analysis from him and the team on your Bloomberg terminal. Just type in MLIV Go. You'll have all that right up on your screen. Let's go from the macro to the micro and get our stocks to watch with Joe Easton from our equities team. Joe?
Morning, Kriti. So we're watching Telecom Italia shares today after the sale of the company's landline network gets approval by the European Union. It's a massive deal with KKR worth around 22 billion euros. The EU is clearing it without the need for an in-depth probe, saying there isn't sufficient competition concerns for it to be investigated further. Now, the deal is aimed at slashing Telecom Italia's massive debt load, and debt has been the big worry for this stock. So we can see on the screen here they gave an update on their debt just a couple of months ago, and it spurred a 25% drop in the share price on the day. Analysts said that they essentially downgraded their debt forecast, so this could potentially be a bit of a boost. But as we can see, analysts not that worried. 11 buys, only one sell over at Exane BNP Paribas. A lot of those buy ratings, maybe they're going to be happy with this news this morning. Then we're also over in France looking at Sanofi as their drug Dupixent, their blockbuster treatment for asthma and skin conditions, is clearing a European Medicine Association investigation for a different illness over in the COPD space, which is a chronic lung disease. And it would be the first new approval for that issue, according to the Bloomberg report today. Now, Sanofi has had its own issues as well. It's another one that's had a drop. It's dropped by around a quarter back in October last year. As they said, they'd be spending more on R&D and investment on that kind of thing. But this approval in the lung space is potentially going to be a bit of a surprise for the market. There's another one which analysts are very positive about. 22 buys. Again, only one sell on that one. And this drug approval could be another positive for that stock today. Then we're also looking at clothing because we had a massive rally out of Gap in the US yesterday. The stock soared after their earnings smashed expectations in all of their main divisions. There it is on the screen, up 23.4% in after-hours trading. Now, Gap beat estimates on their main brands, also Banana Republic, Athleta, and they upgraded their forecast, saying sales will be slightly higher for the year instead of being expected flat. We might see a bit of a read across in H&M, the Zara owner Inditex, and also Next as well. Potentially Primark, AB Foods. However, we got separate news of a big shareholder selling stock on that one this morning. So I think AB Foods is going to be lower. But generally, the picture for apparel should be positive, given that big jump for Gap in the US last night.
All right, Joe Easton, our equities reporter, we thank you for the stocks to watch as we look ahead to the market open in just about 7 minutes' time here in the UK. I'm keeping an eye on the likes of ASML and ST Micro as we look for the read-through of the Nvidia story, the US tightening its restrictions on chips going over to the Middle East. But we are not seeing a lot of action in terms of futures at the moment. It's pretty flat in terms of the Euro Stoxx 50 futures at the moment.
It is pretty flat. We'll have to talk about kind of what the sectoral read-through here is. The rotation is really interesting because the theme on both sides of the Atlantic seems to be this tech leadership. And you're starting to see this question of, okay, well, are there cracks then emerging and not just the demand for the fundamental kind of cloud services that have been driving so much of these companies that aren't necessarily investing in AI, but also is there demand then for some of these stocks as well because they're so juicy. They're trading at these valuations. There's so much green on the screen. So to see Joe kind of come in and say, well, apparel and retail may actually be the winner today is quite interesting. They're usually the laggards.
Yeah, really interesting. Those headwinds potentially coming from the likes of gaming, but data centres the focus as they are in the Middle East restrictions story. We're going to keep an eye on those shares as we head towards the open. That's coming up next. Futures on Euro Stoxx 50 futures are currently flat to the upside. We'll be there in a moment. This is Bloomberg. Welcome back to markets today. A few minutes to go until the start of cash equity trading. You're looking at futures flat here in Europe. And we did have the data from the US yesterday, but the highlight is today PCE coming later. We had some European data earlier as an upside surprise on inflation from France. Does it feed in? Unlikely, really, because it was the smallest of surprises. You've got euro dollar at like 108 currently, and so not a lot moving there. But we do wait for the read-through of the latest Nvidia news, taking a blow yesterday because of these new US chip restrictions to the Middle East. Do we see a read across into the likes of ASML and ST Micro this morning, Kriti?
I also wonder how much of it is a rebound. I'm going to argue a different side of the case. We keep talking about this read-through and the fact that we may actually see some of these tech names indicated lower. Also remember the likes of SAP and ASML had that read-through already from Salesforce the day before. So I wonder if you see, even going into the weekend, a little bit of a pairing some of those losses. Of course, that's going to be one of the sectors we watch. Commodities is another one. We had a lot of drama around BHP and Anglo American this week as well. So that's going to be a crucial question of how do you actually, now that the dust is settled for the time being, while we're waiting for some more of those headlines, if BHP then gives you a renewed offer down the road, what does that where does that leave the commodity sector? So that's the sector I'm watching. And then you mentioned the China story at the beginning. There's always a read-through into luxury. I'm putting my Guy Johnson hat on. Can you tell? Throwing everything at you all at once.
Yeah, he likes to steal all our sandwiches, doesn't he?
Absolutely.
You're the plumber, he's the sandwich stealer. But yeah, we do keep an eye on commodities, obviously. We've got the OPEC Plus meeting coming at the end of the week, and you've had oil juggling all these different factors coming in. We're 8 seconds away from the open. Who's going to move when we get there? We take a look now. So the stock 600 is currently opening higher this morning, 0.6%. And if you break it down by sector, you've got most of them in positive territory, led by real estate, top of the basket, higher 1.9%. Bottom of the basket, tech, down 0.8%, but 17 out of 20 sectors in the green this morning. Look across the continent, you've got the CAC 40 higher 0.6%, the DAX flat, but the FTSE 100 also flat, and the FTSE 100 higher 0.1%. So it's green across the screen as we look towards PCE later, Kriti.
Yeah, and seeing a little bit of an interesting kind of dynamic here. We were talking about that tech being the laggard in the States, retail being the potential outperformer. This morning, when you look, it's still kind of the opposite. Remember, we are still early days. We are still seeing the shakeout. But you talk about that leadership. My eye goes immediately to some of those individual movers, for example. Your biggest index weight, and I really like to look at this from an index perspective, is Novo Nordisk. So you're seeing your healthcare names, which, by the way, have been the outperformer all week long, on the back foot. So, again, a little bit of that rotation trade as opposed to some sort of fundamental story driving it. But we were also talking about the commodity picture. That's where the leadership is. Some of your biggest index contributors on the Stock 600, Shell at the top of the list alongside ASML. You usually don't see tech and commodities rally together unless it's kind of more of a cyclical expansionary narrative. Today, it just feels like it's net reversing the move we saw yesterday.
Yeah, as I say, tech at the bottom of the basket this morning. Looking into those particular names we were flagging before the open, ASML is higher at 1/10%, but ST Micro just flat to the downside, so not a lot of read-through yet or at all this morning.
Absolutely, and Diageo is going to be another one that I point to, and I think that might be a little bit of a consumer read-through as well. In terms of some of your biggest volume movers, National Grid really taking a lot of the attention here. Remember, this is a story that we've been watching quite substantially in terms of their balance sheet, so we're going to keep an eye on that as well. We continue to talk about the healthcare sector. GSK is going to be one of your big ones as well. Total keeps coming back into the narrative. Remember, you're seeing a lot of commentary from the C-suite there, talking about potentially a cross-listing with Paris and New York. How do you actually factor that into the macro narrative is a different story, but it's interesting that that keeps coming up, especially when it comes to some of the leadership, really, in the oil space. If Guy Johnson was here, he'd talk about oil multiples.
Do you miss him?
A little bit. I'm not going to lie. But
I won't take it to heart.
Lizzy, it's not personal at all, but it's only because he's conditioned me to think a certain way. This is the Guy Johnson effect. He would also say, let's go from the micro to the macro. So let's talk about that a little bit. He would say, let's talk about what this rate story is, because ultimately that's going to show up in this macro narrative as well as we kind of shake out whether we are ultimately late cycle, early cycle, how long is this going to really last, and is really the rest of the world at the helm of the Federal Reserve in terms of where they stand. Take a listen to what John Williams at the New York Fed had to say.
Looking at this broader context, the behavior of the economy over the past year provides ample evidence that monetary policy is restrictive in a way that helps achieve our goals. We're seeing clear and consistent signs that the imbalances between supply and demand in the economy are receding, and we've seen a broad-based decline in inflation.
New York Fed President John Williams there saying, look, policy is still fairly restrictive, but he may be starting to see a little bit of division. That is not the consensus view when it comes to the FOMC. Lori Logan, for example, a Dallas Fed president, saying things aren't restrictive enough. Let's bring in another voice here. Karen Ganesh, head of investment communications in the U.S. Global Wealth Management Chief Investment Office, joins us this morning. Walk us through this divergence at the Fed. How concerning is it from an investment perspective?
Yes, well, clearly we've got the Fed trying to grapple with a combination of growth remaining pretty robust, so no imperative to cut interest rates, but also inflation starting to fall and some signs that there is some weakness coming through in the retail side. So obviously they want to make sure they're not putting their foot on the economy too hard. So they're trying to balance all of that out. I mean, our view is that the Fed is most likely to be cutting rates around September. But what you're hearing right now is that debate both around when is the right time to start, but also what is the appropriate level of interest rates. And I think you're hearing both of those debates coming through, and that's what's leading to some of this apparent divergence at the Fed.
So what do you do then with this bond market and with the stock market? Are they even related at this point?
Yeah, well, you've seen kind of correlations moving all over the place. I mean, traditionally, when people are worried about the Fed, you'd normally expect, that dynamic where when yields are rising, then stocks are falling. We've started to see some of that coming through in recent days. But I think the overall trend that we've seen so far this year is really pretty decorrelated bond and equity markets. And you've seen that equity market breaking new record highs, despite the fact that bond yields have actually been edging up. So, I think that speaks well for investors who are looking to diversify, and it is reducing volatility at a portfolio level.
And so we've had 4 straight months of gains for the Bloomberg Dollar Spot Index. May's primed to be the first month where we actually have a down month since December. It's been a rough ride. It sets us up for a snap higher off the back of the core PC number if it proves more stubborn than expected. Do you think there's further room for the dollar to run higher this summer?
Yeah. Near term, the Fed is likely to be one of the later central banks to cut interest rates. So we're likely to see the ECB cutting rates first, the Bank of England cutting rates then probably in August. And we think that could lead to some very near-term dollar strength. But the bigger picture here is that the dollar has been pretty range-bound against things like the euro for quite a long time. And we think that the next big trade is going to be for the dollar to weaken in the second half once the Fed starts cutting interest rates and once the market starts pricing in a more convincing rate-cutting cycle from the Fed. So, we think that what we're telling clients to do is that if the dollar strengthens near-term, use that as an opportunity to decumulate and position yourself for dollar weakness later in the year.
Yeah, because I was going to ask you about how much of an issue divergence divergence from the Fed for the ECB would be for euro dollar. But I also want to factor in the latest inflation data that we got this morning. Another surprise from France. We had one from Germany. Does it muddy the rate path ahead for the ECB beyond June? That seems to be cemented, well telegraphed already.
Yeah, I mean, well, we talked about divergence at the Fed. I mean, the ECB clearly has a much bigger task because it has, all those members to try and get on the same page in a slightly consensual style in terms of when they cut interest rates. So I think what we've seen is that they've pre-committed to that rate cut in June, and that's highly likely to happen. But what we might see at the communication then is them stepping back and saying, OK, well, July is maybe a bit less certain, and then maybe in July we'll start to get more forward guidance on the next month. So it's clearly a consensual course for the ECB, but we think that ultimately once they start moving with some conviction, then that's going to be a train where they're going to keep cutting.
So when we're talking about then this dollar story, I'm circling back to that. Is it, you talked about positioning into weakness into the back half of the year. It's consequentially when the U.S. election is happening, of course, as well. Does the dollar at that point then serve as some sort of hedge?
It's very interesting, the dynamics, because traditionally the dollar is a risk-off hedge, and when people are worried about global markets, they seek the safety of the dollar.
Yeah.
But one of the key concerns we may have around the U.S. election is that both sides are likely to be talking about policies which are likely to mean a still wide fiscal deficit. We've already seen some weakness this week in things like some of the Treasury auctions, and if that starts to become a theme for investors, then that fiscal situation for the U.S. could lead to concerns about the dollar and dollar weakness, and particularly if that then gets exacerbated by any comments, particularly from Donald Trump, around the independence of the central bank, and that kind of thing could be, again, quite a negative for the dollar in the second half.
You said fiscal situation, and my ears immediately perked up. January 2025, we hit the debt ceiling again. First thing on the new president's docket. I love to say this because everyone's talking about Trump policy and tariff policy, et cetera. No one's paying attention to how you hedge it. Play doomsday with me for a little bit. I'm a journalist. I can't help myself. What happens? We hit the debt ceiling. We have these negotiations. What happens to the bond market or the dollar? Is there really anywhere else for global investors to go?
Yeah, well, I mean, I think people have been looking at gold very, very actively in recent weeks and recent months because of that very strong central bank buying that we've had from emerging markets, also supporting that trade. So I'd expect to see gold doing relatively well in that scenario. People might look at other safe haven currencies, things like the Swiss franc, even the Japanese yen can attract bids during those kind of times. So I think it is possible that you'd see strength in some of those other assets as well. Very near term, could you see some technical flows back into the dollar in that kind of situation? Yes. But if people are then taking a step back and thinking, OK, well, what currencies do I want to be positioned in over the medium term against a challenging fiscal situation, perhaps in the US, then they would likely move away from the dollar and towards some of those other, perhaps more stable currencies.
We're going to dig more deeply into the South African political situation with Jennifer Zabasajja, our reporter on the ground. But I do want to ask you about the rand and the market implications, because we've seen it down on the worries about the potential makeup of a coalition. What is your outlook for the rand as it relates to the politics?
Well, I'll talk more generally about the emerging market currencies because, we think that's going to be quite an attractive area as we get into that time of dollar weakness in the second half. We like the Brazilian real right now, very high local interest rates, has been relatively stable over the past few months. And we think that kind of trade is the sort of thing that investors will be looking for in the second half as the dollar's weakening. Where can I get higher interest rates? Where can I get attractive carries? So we think a diversified basket of emerging market currencies could be attractive in the second half. Obviously, there are heavy idiosyncratic risks, as you highlight, so diversification within that basket does make sense.
So is that then just a story of picking up the yield wherever you can find it? My favorite, I'm not going to press you on the South Africa story, but my favorite kind of market read-through was South Africa offers some of the juiciest yield right now in EM. Now, a lot of that is risk premium that's baked down for a lot of kind of political concerns, so that's a different story. But in the context of a 2-year that's almost at 5%, is that what the bond market is right now, just a pickup in yield as opposed to directly responding to a fiscal fundamental story out of the States, for example?
Yeah, well, right now, if Fed interest rates are still above 5, then people are quite happy to just take that yield in relatively high-quality debt. As those rates start to come down, as there start to be concerns about perhaps a weaker dollar, perhaps worries about US fiscal policy, then we think we're likely to see more of that reach for yield. And I think that's what investors, as we get to the middle and the third quarter of the year, should start to be thinking about.
Okay. I'm asking everyone this. What's the floor in yields right now on the 10-year?
So we think it'll fall below 4. So we're looking for around 385 by the end of the year. So we'll put I don't know 3.8. I'll say.
Okay. All right. UBS Global Wealth Management's Karen Ganesh making a pretty bold call there, 3.8 by the end of the year. We thank you so much. And really quickly, as we talk about this bond market, we should get a quick check on the stock market as well. Lizzy was talking about how much I miss Guy Johnson. I got to do his sensational 6 and get a quick check on some of those stocks because you are seeing very low volatility right now when you look at some of the bigger players. Your biggest move is really coming out of Nestle, higher by 1.3%. Schneider Electric getting there as well, down about 0.4%. But the rest, even Ferrari, unchanged right now. ASML, LVMH, your normal heavyweights, not seeing much action. That's your sensational 6. Let's get a little bit more into the nitty gritty. Joe Easton is here with some of the individual stocks on the move.
So lots going on in the movers at the open of trading. Take a look at Telecom Italia now. We're down 5%. The sale of their grid business to KKR has been approved. But the reporter in Italy pointing out that the news broke just before the close of trading yesterday, spurred a spike, and now we are seeing it giving up some of those gains. So it's a buy the rumour, sell the fact situation. Telecom Italia is coming down. It's a 22 billion euro sale. It is a big deal for them, but potentially priced in, as we're seeing in that move today. Then in terms of shipping stocks, a good Bloomberg report out from BI Bloomberg Intelligence on the terminal today. Have a read, saying that shipping rates are up 56% since the Red Sea issues at the back end of last year. And that is a big spike, and it is beneficial for companies like AP Moller Maersk, Hapag in Germany, and Frontline, the Norwegian carrier of oil in shipping. We're seeing gains across all of those. It's one of the best performing sectors that we've got in Europe this morning. Then we're going to look at deals because we have got a lot going on in that space today. NatWest, we saw the government selling more than £1 billion worth of stock last night. That was priced at a very slight discount, but we're coming up very slightly. There was question marks whether the UK election would delay that, whether that would actually now be put on the back burner, but we're seeing the Conservative government continue to sell down that stake, and there is a lot more still to go. They've still got a massive chunk of that. Fraser's Group, Mike Ashley, he loves a bit of Hugo Boss, and he's buying more stock. He's still the largest holder of shareholders, and he's increasing his stake in the German luxury retailer Hugo Boss today. We're seeing Fraser's coming down very slightly, Hugo Boss edging very slightly higher. Then Alpha Financial over in the asset management tech space. There is a bit of a share sale going on in that one, a holder dumping some stock, but not really seeing a decline. We're actually up 2.8% for that one in the UK mid-cap space. We'll look at apparel. We all need to refresh our wardrobes for the summer, and we're seeing the H&M and Inditex share prices gaining a little bit today. We had Gap last night jumping 24% in the US following their earnings. That is maybe a bit of a positive one for those two. But JD Sports out of the UK had results this morning, and it's very, very negative, warning of more weakness in the US, where they now get about half of their sales. They're big partners to Nike, Adidas, all of those brands in the US, and they're seeing weakness there, down 7%. And as we said in Stocks to Watch, AB Foods has an investor getting out of that stock today, selling a bit. They're still holding a large chunk of the shares, but selling a lot of stock this morning. We're seeing weakness in that one. Want to take you over to one of my other favourite spaces, the gambling sector. We got Flutter today. This one is weakening. Take a look at that one. The company leaves the FTSE 100 today because, as we know, they are leaving the main London primary listing and they're going to the US, given they've done this deal for FanDuel, got a lot of their money coming out of sports betting, as I said before, all those sports like American football, baseball, that I do not understand at all. But Flutter coming down 7% because they're no longer in the FTSE 100. So funds, tracker funds, selling the stock this morning. Finally, you mentioned earlier the Salesforce issue yesterday, Kriti, that hit all those tech firms. And we're seeing Capgemini today downgraded at JP Morgan. They go neutral from overweight. They were a long-term buyer of that stock, but they're recommending that you stop buying, and we're seeing it down 4%. Jefferies also cutting that on. It's a 30 billion euro French tech company. It's the worst performer that I saw among the large caps. Capgemini in France, down 4% in Paris this morning.
All right, Joe Easton from our equities team, lovely to have you. Thank you for that. Our update on the stocks that are moving at the open, 15 minutes in, and we're looking at the stock 600, currently flat to the upside. The FTSE 100 higher 0.1%, the CAC 40 higher 0.2%, and the DAX flat to the downside. It was a surprise to me that JD Sports movement there off the back of its results. You did see a bit of a gain for JD Sports yesterday, helped by the US consumer stocks. Foot Locker shocker, 31% up, and that helped JD Sports yesterday. But as Joe says, this morning, JD down 6.6%.
Yeah, it's interesting to mention consumer stocks because when we're talking about those heavyweights in the sensational six, Nestle outperforming as well, higher by 1.3%, I believe, last time I checked. And we actually looked into some of the reasons for it. They were in a fireside chat with JP Morgan yesterday, really talking about the fact that these weight loss concerns from the likes of Ozempic, for example, isn't going to kind of interfere with the strong consumer needs as well. So there's a really interesting kind of theme running through here, from apparel to bedding to even the likes of food and big box retailers that we're seeing across the board when we talk about the inflationary story. It doesn't seem to be getting in the way. And that's actually where we're going to go next in terms of some of the specific micro stories that we're going to get to and how it actually feeds into the macro. Coming up on the program, French inflation coming in higher than expected. Remember, it follows German weakness earlier this week, strength over in Spain. How do we make sense of all of it? We're going to look ahead to the wider Euro area CPI data due out later today. That conversation next. This is Bloomberg.
This is Markets Today. We are 20 minutes into the start of European trading. We have got the stock 600 flat to the upside, but I'm looking at HSBC here. Those shares are up 0.2%. We've just had the news that they're aiming to pick the successor to Noel Quinn, the CEO, by July. So rather like Rishi Sunak, we were promised a vote in the second half. The chairman of HSBC had promised us the successor news in the second half, and it's coming early. So we had his surprise exit in April from Noel Quinn, and now we know that we're going to hopefully have a successor by July. The shares up. Banking as a sector is up 0.3% this morning. As we look across Europe, you've got the CAC 40 higher 0.1%, the DAX down 0.1%, and the FTSE 100 higher 0.1%. But we can move from banks to central banks now, because we've also had some new data this morning. French inflation accelerating this month for the first time this year and mirroring trends elsewhere in the region. This, of course, as we have the central bank preparing to lower interest rates next week. Christine Lagarde preparing her remarks on how she lays out the rate path beyond June. And we can get some advice now on how to do that from David Powell, our senior Euro area economist here at Bloomberg Economics. Good to have you with us, David. I just wonder whether the French and German inflation prints, first of all, do muddy the rate path beyond June, because we seem to know that June is going to be a cut.
I don't think so, really. When you look at the source behind the surprises that we've seen for the countries that have already reported inflation for the month of May, it's really energy costs. There's nothing the ECB can do about energy costs. Monetary policy doesn't have a big impact on those costs. What the ECB is going to be focusing on is underlying inflation, in particular services inflation. And if we look at the French report that came out this morning, services inflation dropped in May, and that's going to be welcomed by the ECB, and we'll see when the euro area figure comes out later this morning how that is at the euro area aggregate level.
And so in terms of the communications, how does Christine Lagarde communicate the path ahead? Because she's got to kind of say, we're really confident, we're going to cut in June, but then she needs to be vague about the path beyond that. How does she strike that balance?
Yeah, probably what she's going to do is she's not going to endorse another cut in July. The hawks have already come out and said that they don't favor a move in July. They want more data, and that data is going to be the wage data that is released once a quarter. So after the data we have in June, we won't have data on that again until September. So it kind of rules July out, although there have been some members, such as the governor of the French Central Bank, who said we shouldn't rule out July, but he does not seem to be in the majority opinion. So she'll probably be very tight-lipped about July, certainly not endorse another cut. And if she does say, for example, we're going to need more data on wages, that's going to be a subtle indication, or a not so subtle indication, that a movement before September is unlikely.
David, the common thread between the three major pieces of data that we got this week, Germany, Spain, and now France, is that energy continues to tick higher. Why are we not talking about it more?
Well, energy is ticking a bit higher, but if you look at this in a much broader context, these movements are very small. Not too long ago, inflation in the euro area was close to 10%, and now we're talking about going a little bit above 2 to a little bit more above 2. We're not talking about these huge moves that threaten to dislodge inflation expectations after the outbreak of the war in Ukraine.
So that's the monetary policy story. Let's factor in the fiscal as well. The outperformance, and I would say some of the strength you're seeing from some of these European countries and European economies, feels like it's really a function of the fiscal spend. How much of that is true?
I think we're seeing some improvement in the economic data at the start of this year, the data we've had for the first quarter, and more timely survey data, we're seeing that as well. Really, but that is that real incomes are rising as inflation falls. So as inflation is no longer eroding people's purchasing power as much as it once was, they're able to buy more. And that probably explains the improvement in the economy we're seeing, and that's likely to gather momentum throughout the year as inflation continues to decline.
And as we look ahead to the PCE number later, and as we end the week, after those French and German inflation beats, which you've slightly discounted, how different is Europe looking from the US at this point?
Well, the big difference between the euro area and the U.S. is despite all the interest rate hikes we've seen in the U.S., the economy there remains relatively strong. That's not the same story in the euro area. Last year, for example, the euro area economy flatlined and the U.S. economy expanded by almost 3%. That's a big difference. And the ECB doesn't have the same problem the Fed does now in terms of really having to slow down the economy, because that's already happened in Europe.
All right, David Powell, senior euro area economist for Bloomberg Economics. We thank you so much for walking us through some of the dynamics that we're seeing in the inflationary space. In the meantime, as we were speaking about the macro, we should talk about what's been happening in Asia. It looks like the Hang Seng Tech Index is down 10% from the high that it set back in May. That weakness that you're seeing in the tech space really going global. That 10%, though, is perhaps setting the course for a technical correction. Do we then get to a perhaps more accelerated speed, especially when we're talking about the pullback in NVIDIA, the pullback in Salesforce, what that read-through is out into Asia?
Yes, indeed. So we're currently, that's the Hang Seng. Here in Europe, though, the stock 600 is flat. Really not a lot happening this morning, Kriti. Not quiet on the news front, but it is quiet on the markets front, it has to be said. And coming up, we're going to be speaking to the chief economist and chairman at LBV Asset Management ahead of the OPEC Plus meeting this Sunday. Of course, it coincides with that Aramco share sale. There's plenty to discuss, and there's plenty at stake here for Saudi Arabia with this supply cuts meeting. So we'll bring you more on that next with Cornelia Mayer. This is Bloomberg.
This is Markets Today. We're about 30 minutes into the European trading day, seeing a couple of pockets of stories here. You are seeing a little bit of a rotation in the market, which kind of feels like, despite all the news flow we're getting on the geopolitical front, maybe not translating into the markets, perhaps just that rotation going into the weekend. Well, let's get to another story, because there is plenty to monitor this weekend, including, of course, the OPEC meeting on Sunday. OPEC Plus delegates have told Bloomberg that the group is moving closer to an agreement on oil output cuts that could stretch all the way into 2025. Let's talk a little bit about that strategy. We're joined now by Cornelia Mayer, chairman and chief economist over at LBV Asset Management. She lives and breathes the oil market. Cornelia, a pleasure to have you on the program. Walk us through that strategy here. Talking about cuts going all the way into 2025. I'm struck by the confidence of the market at the moment, especially from a macro perspective when we're talking about potential weakness on the horizon on both sides of the Atlantic.
No, absolutely. And they look at that potential weakness, and the ministers look at interest rates being lower for longer or low for longer. So that really impacts them. The other thing that impacts them is, there's so much. You saw the U.S. GDP being revised downward to 1.3%, for the first quarter. You see what's happening in China with real estate woes and with slow factory performance and with really no more oil being bought in, or not the amount bought not being increased. So they look at it, and then you have the speculative money where a lot of the long positions were put into short positions. So all of this is a bearish market. Plus, you also have more output from the U.S., from Brazil, from Guyana, even from Norway. So they look at that and they go like, well, it's one side is the demand side, the other side is the supply side. So something's got to give.
Is there a question? You mentioned the U.S. supply story, and it's fascinating because just this week alone, we've had on the big oil front potential mergers announced, consolidation from ConocoPhillips, for example. Marathon Oil, Hess voting by their shareholders to be a part of Chevron as well. This consolidation is the right word, that you're seeing in the U.S. shale market brings back some memories of 2015, 2016. I'm curious whether that's a positive thing in the long term, or is that turning into a more long-term threat on market share when it comes to OPEC?
It's certainly, if you're the U.S., it turns on a threat. You look at market share, you look at the big increase of U.S. production, but also you see these mergers. They always happen when the oil price is low, and when you expect it to be low, because obviously it's cheaper to merge when the oil price is low, because the companies are valued at a lesser price point.
But then thinking about the impact of growth on the oil price, I wonder how much the link is weakening between growth and oil demand because of the rise of electric vehicles.
Oh, you're absolutely right. And I'm really looking forward to seeing and I haven't put that into my model yet because I'm waiting for what I'm seeing in the US, the driving season. And not in the middle of the country, but on the coasts, you have quite a bit of electric vehicles. So what is the impact of EVs? And then also globally energy transition. It used to be that a percent growth in GDP anywhere could be put straight through to oil. Not anymore, especially not in OECD markets.
Yeah, and then when you've got the COP communique, transitioning away from fossil readily fuels in energy systems in a just, orderly and equitable manner, they say, how does that translate through? How quickly does it really impact the market?
Well, it does impact the market. I think that's that's a very long-term thing. But I see two things here. I see OECD where you're transitioning away much faster because energy transition is expensive and OECD countries can afford it. But then I look at Africa, South Asia, where, the money is not there for this easy transition, where it is still much more correlated, the oil price, or the demand and the GDP. And mind you, the next 2 billion people that we will have on planet Earth by 2050, they're in Africa and they're in South Asia.
As we talk about this EV transition, we have to talk about the copper story as well. These momentum trades and the short squeezes that you're seeing in copper right now. And, of course, we're talking about consolidation in energy. Plenty of consolidation drama in the copper space as well this week. What is the story around copper, especially when you have a lot of geopolitical risk around it? We were talking about it in the context of South Africa this week, but the election in the States affects that EV transition story as well in terms of infrastructure investment. How does that show up in the copper price?
It will show up in the copper price, and you will see, depending on who wins, it will in the US, it will show up, because clearly when you have a policy that goes more towards EVs, you need more copper. But then there is more. The whole energy transition is not just EVs, right? You have all sorts of sources of energy where you need copper and base materials, and you also have China. China is actually, although factory output is slow, copper demand is still quite strong. So you need to look at China, you need to look at India, you need to look at also Africa. And you see it strong. And the thing is, again, when you have on the producer side geopolitical tensions, then you fear for the supply, right?
That's the fundamental story. Let's get back to the markets here, because at the very start of this segment, you specifically talked about, you used the word speculative positioning. I love that. Let's get nerdy. Where in a portfolio does copper and oil find itself? And the reason I ask that is because there was a time not too long ago where you bought a basket of commodities as a macro investor, and that was your hedge that lasted you 1-2 years. Are we re-entering that kind of reputation for the energy sector?
I don't think so, because with oil, oil and copper are sort of a little bit different in the sense that copper is, you always need copper, but copper is very much part of the energy transition story, and oil is sort of on the back foot of that story. So yes, it's correlated, but I think it's less correlated than it used to be. It's a little bit like what we've discussed earlier. Oil is no longer the clear throughput to GDP growth in every market. In some markets it is, in some markets it's not.
Now, oil, of course, is crucial to Saudi Arabia, and I just want to take us back to the OPEC Plus meeting that's coming on Sunday. Of course, it coincides with Aramco's share sale, Saudi leading the efforts to restrict output. I wonder just how reliant Saudi is on these output cuts to balance its books, and your outlook for the oil price longer term, because we hear that they need $100 a barrel. If it's going to be 75, 76 like the IMF's forecasting, can they really match that?
Actually, it's interesting. There are people who say it's above 100. There are people who say it's in the 90s. And then I've just recently heard from a very senior sort of oil ministry person. They're happy with the low 80s. It's very difficult because when you look at the Saudi budget, it's not. Some items are not in there, so it's very hard to. I feel people who tell me it must be X are very brave, and they're moving targets. And one thing we shouldn't forget: Saudi has enormous debt capacity. Saudi is still privatizing. You have another 0.65% of Aramco shares going on the market on Sunday, as you said. So there's debt capacity. There are other ways to raise money than just oil. And the whole thing about the Vision 2030 is transitioning away from the sole dependence on oil for its revenues. And they're really doing that. They're really going I've just come back from Saudi. They're really working on that very hard.
That alliance, of course, between Riyadh and Abu Dhabi it feels like strengthening after a little bit of division that we've seen in previous years. I'm curious, though, about the non-OPEC supply from the likes of Russia, Iran, etc. Where does that fall into the equation?
Well, that's very interesting. And, there are the baselines, right? And you look at UAE, who have, a lot of spare capacity, but Saudi also has a lot of spare capacity. But then you look, Iran can produce quite a bit. You look at Libya, who can produce quite a bit. Nigeria, who used to produce 400,000 barrels more than they're producing today. Russia having a new field coming on stream, which would be 2 million barrels a day. So there is pressure there. But it's a very tricky thing to rebase or rebalance the quotas. Last time that happened was with the African producers last June at the meeting, and that caused quite a bit of upset and led also to Angola leaving.
All right. Cornelia Meyer, Chairman and Chief Economist at LBV Asset Management. We could go all day with her. We thank her so much for walking us through a story that we will be monitoring, of course, on Sunday. I do want to bring back our top story overnight, though. Donald Trump has been found guilty in the first criminal trial of a former U.S. president in the nation's history. A New York jury convicted him on all 34 counts in his hush money trial. Manhattan District Attorney Alvin Bragg, who brought the case against Trump, spoke after the verdict was handed down.
While this defendant may be unlike any other in American history, we arrived at this trial and ultimately today at this verdict in the same manner as every other case that comes through the courtroom doors, by following the facts and the law and doing so without fear or favor.
Alvin Bragg there on the heels of that verdict. Lizzy, I think what's so striking to me as the American in the room is that it feels like this was largely expected for a lot of the American voter base. But then, I walked out of my apartment this morning and the shock from the international community that this had happened was surprising.
I've got to say, that's got to be the title of your show, The American in the Room.
I'm working hard to get us rebranded to that.
I am shocked by this as a European, as a Brit. I'm shocked that I was listening to coverage last night saying that they'd be stunned if anything changed in terms of Republican support for Trump. It's what I come back to when I asked you about the swing voters. Surely they would be surprised by this, but even the market seemingly not surprised by this when we were talking to Ben Guttridge about it.
Yeah, and we should also add that this is not his most kind of consequential case in terms of the effect it's going to have on his presidential campaign. We had Kevin Whitelaw at the top of the show talking about the fact that even this felony conviction, yes, that is a loaded term, of course, but it is still only a state felony conviction. It is the lowest level. He's still dealing with potential convictions of treason that would effectually affect his presidential campaign in the likes of Washington, Georgia, Florida, his role in the riots of 2021 or lack thereof, his role in terms of moving classified documents from the White House to Mar-a-Lago, his estate in Florida as well. That would have, in theory, a bigger effect in terms of even his candidacy. And already you can see that this is getting pushed back further and further because they're having the same issue in terms of the court cases and the legal system in the states that they're having at the Federal Reserve, is that the closer you get to the election, and I'm sure the BOE is having this as well, the less you can really do because of how much it affects voter turnout. And ironically, that was the exact point of this entire case. It wasn't the fact that it was a hush money payment. It was a hush money payment at a time that could affect voter turnout and voter opinion ahead of the 2016 race.
Yeah, none of the officials wanting to get their hands dirty by looking like they're tarnishing themselves, getting involved in the politics affecting the voter turnout. Yeah, really interesting stuff, even though you still got Elon Musk and the likes of Steve Schwarzman, Bill Ackman expected to endorse Donald Trump. Seem to be running out of options for who to back at this point. But we will keep across the Trump story for you. But we'll turn to some more drama next in politics because we're looking to South Africa. The projections showing that the ruling ANC could lose its majority, a historic loss, and be forced to partner with rivals. So we'll go to Jennifer Zabasajja in South Africa next. This is Bloomberg.
They can be seen everywhere, in airports, patrolling beaches and parks, in rural areas and city streets.
Mexico's military is now the largest and most powerful it's ever been.
During the presidency of Andrés Manuel López Obrador, over 100 different functions of civilian governments or civilian authorities were transferred to the armed forces.
Since López Obrador came to power in 2018, the combined budgets of the armed forces grew by 150%. But as the new government takes over, citizens are wondering if these infrastructure works are coming at the expense of public safety.
What we are having now is the worst rate of murders in our history.
Widely known as AMLO, President López Obrador's tenure has seen record-high homicides.
What we are having in Mexico is a strong process of militarization of the public life. The armed forces, they are playing a stronger role, not only in matters related to security, but also in infrastructure, building trains, airports.
Una institución como el Ejército o la Marina son mucho más rápidos, dan por su naturaleza y su formación resultados en construcción mucho más ágiles.
Mexico's next president will have to reckon with what López Obrador created, a richer, mightier, and larger military that's more deeply ingrained in private business and government than it's ever been.
Bloomberg senior reporter Andrea Navarro there on Mexico's militarization under AMLO. This weekend, of course, Mexico will choose a new leader in the largest election in the country's history. This is a massive deal, Lizzy, because AMLO right now has a 60% approval rating. That is more than any world leader anywhere that you can imagine, of course, because of term limits. He isn't able to go for another term. To me, the market reaction is crucial here because as we talk about this conversation we had with Ben Gutteridge, for example, is where do you find the yield in this market? EM serves as that. The geopolitical risk is offering that juicy yield. And you can see that in some of these Mexican assets. So many people, at least in the States, go to the Mexican peso or the Brazilian real for that yield. That carry trade with the Japanese yen on one end and the Brazilian real, the Mexican peso on the other, has been fairly lucrative as people kind of wait for the Fed to figure out where they're going to go next. It's a similar dynamic in South Africa, where, again, because of some of the geopolitical risk there as well, their assets have actually proven to be a little bit of an extra cherry on top in portfolios.
And yet we saw the rand take an absolute beating off the back of the political results, the uncertainty over what shape the coalition is going to take there. And we can go to Jennifer Sabasaja in South Africa now for an update on what the politics is going to shake out to be. As I say, the rand dropping more than 2% yesterday after projections of election results showed the ruling ANC falling well short of a parliamentary majority and leaving it really looking to seek a coalition just to cling on to power. So, Jen, you're with us at the results centre in Midrand. Just over half of votes have now been counted. How's it looking? What shape of coalition is likely? How long could it take to get one?
Yeah, I mean, Lizzy, right now, if we take a look at what we actually have, and we just got the bell behind me is just an indication that more votes are coming in. We're just above 55% of voting districts that are counted, about 7.7 million votes. And yes, as you mentioned, this could be a historic election for the ruling African National Congress, potentially them falling well below that 50% majority that they were hoping for. And the second biggest part of the story that has happened thus far is just how surprisingly well former President Jacob Zuma's MK party is doing. Now, I want to make sure to remind people that it's only been around for just about 6 months, but we're seeing the MK party really outperform in some places that have traditionally been ANC strongholds. But yes, I mentioned we're just about 55% of the votes, voting districts that are tallied. And so we still have a bit of a ways to go. We still have some more populous parts of the country to go. But many people are discussing, what does this potentially new era of coalition governments and agreements look like with the ruling party?
Well, Jennifer, walk us through that as well when it comes to the market reaction. Lizzy was talking about that weakness you're seeing in the rand. Markets never like change, nevertheless, a change that's coming after 30 years in power. Walk us through how these markets might shake out.
Yeah. Right, Kriti, and I think just that reaction is really important to note because going into this election, many investors, it was not really the base case scenario that we were potentially going to see some of these smaller parties doing it as well as they were. There was, we did a Bloomberg survey, and many investors were hoping for policy continuity, but potentially looking at the ruling African National Congress with an opposition party like the DA, which is seen as more market-friendly, business-friendly. But just seeing how we saw the rand perform, we also saw government bonds weaken, the benchmark stock index weakening just a bit. Potentially then investors are getting a little bit jittery about what this coalition could potentially look like and what does that mean for economic policy. And in particular, if we do see the ruling ANC teaming up or going into a coalition agreement with a party like the EFF, which is led by Julius Malema, a leftist party, more populist, or even the MK party, what could that mean for policy moving forward? So clearly the market reaction is an indication of where potentially investor sentiment is, but we should say that we still have a bit of time and more votes to come in, and so maybe we'll get some more indication really of what the final results are going to be and potentially more clarity then about what coalition discussions will look like going forward.
All right, Bloomberg's Jennifer Sabasaja rounding out what's been a really stellar week of reporting. We thank you so much for bringing that to us live on Bloomberg TV. And, of course, as we watch the elections this weekend, there's a few other things we want to watch the next 24 hours. At about 10 a.m. UK time, the Eurozone inflation data will continue to trickle out. Remember, France came in a little bit hot. Spain came in a little bit hot as Germany this week came in, weak to not to have that word echo. But then again, the focus shifts to the U.S. later today at 1:30 p.m. U.S. time, UK time. PCE data as well. At the same time, we get those Canadian GDP figures as well. But really all eyes on that PCE deflator story as well as that positioning ahead of the geopolitical risk, because it's not just the elections we're going to be keeping an eye on, but that OPEC meeting as well. It feels like right now markets may just be a little bit sleepy, waiting for that PCE deflator story. That's going to come again at about 8:30 a.m. New York time. It's about 1:30 p.m. right here in the UK. Let's bring in Justina Lee, our star markets reporter. We've been relying on you pretty heavily this week. Justina, this PCE deflator, it feels like it's been the event of the week on the macro front. What do we expect? How do we position?
Oh, yeah, for sure, definitely. I mean, if we look at what markets are currently expecting, I mean, economists are projecting generally good numbers when it comes to the disinflationary story. They're expecting a slowdown in personal income and personal spending, and also, most importantly, in that like core kind of PCE deflator number, they're expecting the slowest increase so far this year. So I think generally everything is expected to point to a good trend, even if it's not entirely enough, I think, for Fed officials to kind of be comfortable with the trend right now.
I mean, speaking of the lack of movement, we had that China data earlier, and even though you saw this surprise hit to the growth outlook, stocks holding up. I mean, how do we factor this in? We've been talking about the China factor in so many different stories. It kind of brings us back to Trump, Kriti, because you've got the US and the EU, of course, accusing Beijing of the excess supply capacity, the excess capacity. So China manufacturers having more risk in the pipeline, depending on how strict the new trade barriers will be under Donald Trump. My point really is just why stocks are not reacting more, and I suppose the answer surely must be that they want stimulus from the government.
Yeah, for sure. And it's interesting because the government kind of has been telling Chinese bond traders, maybe don't just like pile into those bonds. But still, we're kind of seeing Chinese bond yields fall, which has been kind of in an opposite direction with kind of the rest of the world. And I think it does kind of speak to kind of the very different economic trends there and kind of the expectations for monetary easing. And of course, that's going to have like grave implications for the Chinese yuan.
So in terms of this trade here, we're starting to see a lot of Fed speak, of course. Real division just in the last 24 hours between Williams and Logan as well. One saying policy is restrictive, the other saying it's not restrictive enough. What do you do with this bond market? I mean, how high do yields rally?
Yeah, it's really confusing because one point of kind of contention here is like the R star, right? Like what is the neutral rate of interest where monetary policy is sort of not contracting or growing the economy? And that actually is not that scientific. There are many different models giving you different answers. But I think one thing that kind of Fed official Logan kind of pointed to here is that maybe that neutral rate of interest has risen.
All right, Bloomberg's Justina Lee walking us through really how we're supposed to walk through all this Fed speak, the market drama, and, of course, as Lizzy pointed out, the read-through coming in from China. We thank you so much for bringing that crucial story into context for us. In the meantime, as we watch those slew of things going on this weekend, we've got to keep an eye on what's starting on Monday. We don't want to miss our conversation from the IATA annual general meeting. We've got a slew of great guests. Guy Johnson is out on location we're going to hear from really the heads of all the major airlines around the world about the capacity restraints, the demand, and whether or not they can really rally in the face of this macro environment. More ahead. This is Bloomberg.